A decisive turn in the US dollar trend has been seen in the past month. As our April market outlook was published, the US dollar's DXY index sat at 100.1. A month on, as the May edition was finalised, the index was essentially unchanged at 99.9. Now DXY sits near 97, nearly 3% lower. What has changed? Primarily, the move is the result of optimism amongst investors over the global recovery from COVID-19, and hence a greater willingness to take on risk. Highlighting how firmly hope has become entrenched in the minds of investors, this robust US dollar downtrend has been established despite continued strong growth in the global COVID-19 case count, the absence of a vaccine and or effective treatment regime, and with data only beginning to show COVID-19's economic consequence. Given the strength of the sentiment behind it, and in the absence of a clear second wave of COVID-19 in key developed nations such as the US, it seems likely that the nascent US dollar downtrend will persist for the remainder of this year and well beyond. Of the DXY constituents, the euro is expected to appreciate the most against the US dollar, rallying to 118 by end 2021, following a period of stabilisation late this year between 112 and 114. Behind this move is not only broad-based optimism over the global economy, but also specific progress made within the euro area to contain the virus, and as of this month, towards a coordinated fiscal package to renew growth and reduce economic risk for the periphery nations. With little progress made with respect to Brexit and significant uncertainty over the cost of COVID-19 for the UK, sterling won't experience the same degree of optimism as the euro. While sterling has rallied in line with the euro this past month, this was from a very low starting point. Gains from here are expected to be much more muted, with a lift from 127 at December 2020 to only 130 by December 2021. The risks to this baseline view are most certainly stacked against the UK. Turning to Asia, we in the market have remained quite circumspect on the yen through 2020. This is still the case. At end 2021, we look for the yen to be little changed from today's spot level at 107, despite the US dollar index depreciating by about 4% over this time, and as the Asian region drives the rebound in global growth. Japan will struggle to take advantage of momentum around it within the Asian region, and domestic demand will also find it difficult to regain the losses suffered in 2020. Japanese investors are therefore likely to look offshore in pursuit of capital gains and income as global risks dissipate. In stark contrast, we see a robust appreciation in China's renminbi, from 708 as we speak to 690 by end 2020, and then 660 at the end of 2021. The gain forecast for 2021 is larger than for 2020 because it will take time for global COVID-19 risk to fully subside. Doubts over China's ability to rebound will also linger until they prove their capacity. And finally, as even on a hopeful geopolitical view, risks around trade policy are unlikely to dissipate until well after November's US elections. The rest of Asia is also set to benefit from recovery, albeit less so than China. Highlighting this view, we see Asian currencies appreciating broadly in line with DXY, as China's renminbi appreciates by around 7% to end 2021. We'll see you next week.